Canada's housing market is collapsing under its own weight. Prices are sky high, while debt is unsustainable. And the entire economy is one shock away from absolute disaster. In this episode, I'll show you the numbers behind Canada's housing market, the debt, the valuations, and the silk thread that is holding everything together. Not to mention why this systemic problem in Canada is bigger than just real estate. As you can see, one of the main issues is wages have lagged far behind house pricing. Here we have wages versus M2 expansion, which is almost a direct correlation with housing prices. 2.2% compared to 8%. The lower and the middle class are getting outpaced by 6% annually. What do we call this phenomenon? This is known as the financialization of real estate. The underlying asset no longer functions as it was supposed to and becomes a hedge for monetary debasement. In order to understand how we got to this point, first we need to look back to the past at some of the policies that have allowed this financialization to take place at such a massive scale. So I would say 1987, the introduction of mortgage-backed securities was the starting point of all of this. Essentially, what the mortgage-backed security allowed to happen was mortgages now could be sold and bought on capital markets around the world. This opens the floodgates to global capital into, say, your local real estate market. From there, it progressed in 2001 to Canadian mortgage bonds, and then in 2012 to covered bonds, which essentially allowed the banks and institutional investors to capitalize on mortgages off balance sheet. So you can think of these as the plumbing and the pipes that were laid so that global capital and liquidity can flow into these securitized mortgages and real estate markets. And a direct parallel here is the financial crisis in 2008. The whole reason that came about was because all the mortgage-backed securities blew the fuck up. And the whole world blew the fuck up along with it. Everybody was over leveraged, everybody was offside, and everybody was going crazy about the amount of money being made from these new securities. However, the plumbing didn't change after that. It was still there, and it was still active. Keep that in mind, because as we move forward over the next 10 years into 2019 and 2020, during COVID, this plumbing becomes very important because one of the main mechanics that they used during COVID in order to facilitate such a massive degree of stimulus was they slashed rates in Canada to 0.25%. Right, we can see here on the 5-year Canadian 5-year bond got absolutely nuked, tanked. They slashed rates and then they implemented the government buyback program. QE, the Canadian bank, implemented a quantitative easing program to inject cash into the markets. In layman's terms, they printed a shit ton of money, and a shit ton of money flowed through the plumbing that was previously laid in 1987 up until 2012 and so forth into these mortgage-backed securities and into the real estate market. So, two things: mortgage-backed securities and physical real estate. Why these two? On one hand, the physical real estate as an inflation hedge, mixed with the Cantillon effect Those closest to the money printer benefit the most. Those closest get access to cheap credit, and a lot of it. And they look to get rid of cash as soon as possible in these kind of environments. Inflation hedges, things of physical nature like gold and like real estate. And now because these mortgages are securitized, they can gobble up ownership and control mortgages as an asset now. So if you don't know, mortgages are a loan against a house. Somebody's paying you a fixed income to live in that house and pay down that mortgage. And these guys close to the money printer gobble up those mortgage-backed securities, now control essentially people's rent and now profit from that. And we can see here from this headline, I believe it was back, in 2021, that in multiple provinces throughout Canada, Ontario especially is my province, over 50% of these mortgages are controlled by businesses and institutions. Over half of the market is controlled by businesses and institutions. Not by my mom, not by her friends, not by my friends, by businesses and institutions. We had all this money flow in. We had all of these institutions, due to the Cantillon effect, capitalize off it, gain control over the markets. What happened next? After the bank slashed all the rates down to near zero, they did the complete opposite around 2023. Jacked them right up. Inflation was a big problem. Go figure. Rates soared up to 5%. Now, originally, if you're a retail investor, when rates go up, you would think house prices would fall back, hopefully to a median within that price range, or even a bit lower. If rates got jacked up massively like they did, check the 5-year chart. However, this was not the case. Why? Well, let's go back to these article titles. There's 2 reasons here. That being, institutions now have a massive footprint in the market. Mortgages are now a part of portfolio construction. And 2, we just decided to let 1 million new people in every year. And they gotta live somewhere. So we have record high prices already. We have an influx of new people. We have an influx of very wealthy institutions putting these mortgages in their portfolios while also holding hard real estate. What do you think happened to the prices? Not much, guys. Not much happened. There was a 10% reversion. A 10% reversion after about 100% run up. Oh man. What are the effects of this policy and this outcome? Well, house prices are now 10x the median income. 10x, you heard me. 10 times the median salary in Canada to buy a home. That's if you have a well-paying job. If you're below median, you're making less than $60,000. It's more than 10x. Another symptom of the financialization of real estate is that rates are no longer the dominant factor in home pricing. It goes to show that when we jacked the rates up to 5, we had a very small reversion in price. Rates are no longer the dominant factor. It is in fact fiscal dominance and global liquidity now outweigh rates when it comes to pricing. And finally, household debt is right around 180% of income, which means households are almost 2 times levered just to get by. It's unsustainable, guys. This displays it well, the rates versus price. Real estate is no longer a place to raise a family, a dream of the lower and middle class, a dream of my generation that has been wrongfully taken away from us. Real estate is now an inflation hedge for the wealthy and institutions and the banks against poor policy and fiscal mismanagement and spending. We've seen this happen with assets, and PE ratios are going off the charts because global liquidity and monetary debasement are becoming the driving factors of asset prices. No longer rates, but monetary debasement. If you guys learned something, drop a comment down below. I would love to chat. If you guys enjoyed this video, hit the like button. Make sure you subscribe as well. I'm trying to build an audience here, help educate you guys a little bit about finance, try and navigate this complex world and get us through it. Anyways, it's been Chris, and I'll catch you guys in the next video.